There has always been a great deal of controversy around the price of Tesla shares. Last year, the stock price shot up to over $1,000, but it has since dropped once more this year. Regarding the company's actual valuation, experts are making assumptions. While some think the stock price is reasonable for automaker, others think it is significantly overpriced. Why do Tesla shares cost so much? Is it wise to purchase Tesla stock? Is Tesla really worth more or less? Tesla stock is not as pricey as it would seem. According to a note that was just posted by one of the biggest financial services firms in the world, in today's video, we'll be delving into the note's contents and hearing from financial experts about the subject. An investor note authored by analyst Dan Levy was recently posted by Credit Suisse, a leading provider of financial services and investment banking. They go into great detail in this analysis as to why they think Tesla's stock price will reach their price objective and why they are positive on the company. Dan Levy stated in the most recent report that Tesla's margins had increased, largely due to cost reductions. We believe the good margins are sustainable. Indeed, Tesla has shown to be a little more adaptable than anticipated, particularly in avoiding the chip shortage issue. According to Elon Musk, the company was able to use substitutes for chips that were almost hard to find. Herbert Diess, the CEO of Volkswagen Group, claims that Tesla can build new software in a few weeks and simply sew it onto a new CPU. Tesla's capacity to swiftly adapt and overcome obstacles like the global chip shortage depends heavily on its focus on software and vertical integration. This degree of inventiveness and adaptability will undoubtedly reduce expenses and preserve sound profit margin. We believe legacy original equipment manufacturers are making clear moves towards transitioning to an electric vehicle world, he stated. However, we expect Tesla to maintain a lead for the foreseeable future. That they think this way is not surprising, since multiple analysts concur that Tesla is now leading the way in the industry. The document also said vehicle hardware sales have been the primary driver of Tesla's profits up to this point, with some software benefits, particularly for full self-drive features. When Tesla unlocks more deferred revenue and adds more fully autonomous capabilities, it should experience an increase in profit. This is expected to occur at a 100 contribution margin advantage. However, Elon Musk has been promising consumers a self-driving automobile at least since 2016. Many employees and customers can test new and incomplete driver assistance features on US public roads, thanks to Tesla's full self-driving beta effort, also known as the FSD beta. But even though the company hasn't fulfilled that promise yet, some investors are starting to lose hope. We still think highly of Tesla, although we are aware that this is a difficult firm to assess, especially in light of the erratic short-term indicators. We think Tesla is headed toward being a significant automaker with the potential for significantly higher margins. We believe Tesla to have the sole genuinely unique offering in the automotive industry, a very valuable brand, and the capacity to innovate far faster than its rivals, the note reads. Credit Suisse has faith in the electric vehicle brand for two reasons. First off, there are some excellent performance numbers for the Model S in its pricing bracket. The Model S gained a 25 US market share in 2015, as Tesla noted in a table included in the press statement. To reiterate a previous point, in the sedan and SUV segments, it significantly outperformed its competitors with that degree of worldwide domination. In the pricing range of the Model 3, the combined S or X model would imply a price tag of more than $800,000 and sell over 200,000 vehicles. Their second argument is that Car and Driver just declared the Model S to be the absolute best in a semi-autonomous comparison versus the BMW 750i, Mercedes 65 AM, and Infiniti Q50's vehicles. It's astounding to learn that until Elon Musk started recruiting engineers in September 2013, Tesla was not equipped with an active safety driving system. As far as we can tell, the competitor has been honing this expertise for 10 years or more, the memo said. The experts state that Tesla is still leading the multi-decade secular shift toward electric vehicles. For the years 2022 to 2024, they project that Tesla will keep growing its auto sales while keeping profit margins stable. Their projected earnings surpass the Wall Street estimate by 25. I'm hard-pressed to find any stock that fits all the boxes as Tesla does in appealing growth path, both top line and earnings per share, disruption, emission reduction, and so on, stated Mr. Levy. Financial experts feel the price earnings to growth ratio could be a more accurate indicator of Tesla's value because to its rapid growth. More profitable quarters are subtracted from the equation. The price to earnings ratio rapidly decreases as new quarters with higher earnings per share added. The computation of the price earnings to growth ratio involves dividing the company's price to earnings ratio by the growth rate of earnings per share. Tesla saw remarkable growth last year, and in order to maintain its valuation, it will need to keep growing. The price earnings to growth ratio indicates otherwise, notwithstanding the opinion of some experts that the company is cheap, as a price earnings to growth ratio greater than 1 implies that a stock is costly or overpriced. Tesla currently has a ratio of 3.5, indicating that it is overvalued. Nonetheless, Tesla is often considered a growth company, and it has a lower price to earnings to growth ratio than certain value stocks. Currently, General Electric and American Water Works have price earnings to growth ratios of 6.6 and 459 respectively. When evaluated as an automobile firm, Tesla's price to earnings to growth ratio is higher than the industry average. Because they only consider Tesla to be an automaker, many claim that the firm is overvalued. Tesla has been compared to a tech business on several times and is more than just an automaker. They appear to be turning into an AI robot company. This is essential to any defendable firm valuation. Yet, a lot of equities analysts have either disrupted or disregarded this reality by saying it isn't relevant to their study. Some contend that this misconception has caused Tesla shares to be worth half of what they should be, and that AI-assisted driving represents a paradigm shift in both our perception of what a car is and how it should be driven, rather than just a nice add-on for an exquisite vehicle. The conventional narrative about Tesla may change as more experts come to agree with this point of view, and the company's stock price may double in the ensuing years. Due to its compliance with environmental standards, market undervaluation, and advancement, Credit Suisse upgraded Tesla to perform. Doug Clinton, the managing partner of Loop Venture, stated in a blog post that Tesla was overpriced after receiving this memo. The cost of a Tesla is phenomenal. Their items are fantastic, but that's not the problem. What the stock price needs in terms of future growth is the question. There doesn't seem to be a fair chance of a significant future return at Tesla's price. The cost does not include a margin of safety. He stated that purchasing an asset at a price where something may go wrong but still cost a lot of money is what he meant by having a margin of safety. Find not be misplaced. In the meantime, the stock price is still declining. As of today, February 17, it is down 5.9 to $876.35 from its previous closing of $923.39 on the same day last year. Based on historical history, there is a strong likelihood that Tesla stock will rise during the next month. Over the past 10 years, there have been 71 instances in which the stock price has seen a 21-day decline of 20 or more. 65 of these instances have seen share prices rise during the ensuing 1-month period or 21 trading days. Based on previous trends, there's a 65 out of 71 chance that Tesla stock will rise in the upcoming month, suggesting that Tesla shares may be a good investment in the near future. Trevor Young and Dan Levy stuck to their $1025 price target for the company. They continued saying, "We believe the stock should recover," pointing to the stock's excellent fundamentals and the fact that it was caught up in the market decline. This makes sense because, albeit not as sharply as Tesla, automakers like General Motors, Mitsubishi, and Rivian are all seeing a decline in their stock values. There was a disclaimer in the study that read where we could be wrong. Growth companies like Tesla have underperformed by 7, while value stocks have beaten growth stocks by 12. Rising rates could put pressure on secular growers, which is risky for our thesis because any optimistic assessment of Tesla needs to be based on a long-term valuation. Fundstrat Global affirmed this opinion in a previously released note, saying that Tesla is still a significant long-term investment for investors. The company established the groundwork for autonomous driving, and as demand for electric vehicles increases, we think they'll continue to be at the forefront of this industry. Do you think Tesla is undervalued, like Credit Suisse does? Please leave a comment below.